Steve Cotton joins us. He is a financial strategist, and he is the president of Cotton Wealth Management Associates. We had a Fed rate cut this week, which was good news, I suppose. Or was it good news? Steve, thanks for coming on this morning. We appreciate it.
Well, good morning. It's always an honor to be on. I enjoy talking with you guys.
Well, thank you so much. We appreciate it. Was it good news that we saw a Fed rate cut?
I think it was, because it reconfirms the fact that the Fed has now pivoted from almost obsessive focus on combating inflation to more of a focus on the unemployment picture and business decisions. And the Fed rate cut decision was really intended to help support strong economic growth and continued low unemployment. And I think that's a positive thing. We're also anticipating the possibility of another 25 basis point cut in December at their December meeting. And I think if that happens as well, that will sustain us well into the new year.
Is that what this economy needs to kind of give it a little jump start? Or are we going to, in the second part of the question, are we going to see those rates down in the high twos, low threes ever again?
I think we could get down to about 3.75%. I don't see it going a whole lot lower than that unless there is evidence of even more dramatic economic slowing. But the thing that concerns me, frankly, is that this government shutdown puts all of that otherwise positive economic momentum at risk, because not only does it affect 750,000 federal workers, but it also has a pernicious and a negative effect, a ripple effect on down up the supply chain and for retail planning heading into the Christmas buying season.
That's the most important season as well. And with money being cheaper now, I would imagine people are going to probably run up their credit cards a little bit.
Well, they may do that. I mean, if government workers aren't getting paychecks, they definitely are running up their credit cards, which is not a good thing.
Yeah.
And the credit card industry has triggers on these credit cards. So if you are a day or an hour late on your payment, it often will jump you up into what I call a penalty rate, which is outrageous. It should be outlawed, but that's how these credit card systems work, and it's very punitive for people. So we're heading into a point of real economic sensitivity and vulnerability for a lot of people and a lot of families, and the government shutdown does not help that.
Are we going to see mortgages back maybe in the threes at some point, maybe auto loans in the threes? My auto loan is 5.9%. You want to get a mortgage now, it's going to cost you at least that, maybe even higher. I think everybody's thinking back to the good old days, I suppose, of 2.8% mortgages.
I don't think rates will get that low. I think the auto loan rates will come down some more. I think every time the Fed cuts the federal funds rate, it has not a direct but an indirect impact on long-term mortgage rates. But mortgage rates are really the result of a lot of different factors, not just what the Fed's doing. But we could see some relief on credit card borrowing costs and auto loan borrowing costs and things like that. But it also just generally reduces the cost of business borrowing. Now, the negative side of rate cuts is banks end up reducing what they will pay on bank checking and savings accounts, which is already very low. It reduces the rates that people can get on certificates of deposit and things like that. But generally, rate cuts are good for the economy in any environment.
This is Steve Cotton. He is the president of Cotton Wealth Management Associates. Steve, always a pleasure. Thank you for coming on. Happy Halloween to you.
Thanks for having me, and happy Halloween.